Yes, so welcome everybody. Congratulations, you are in the right room for the right panel. And we are talking about digital assets infrastructure and how this is transforming markets, or maybe the markets are transforming the infrastructure. I don't know so far, but I hope we will know after the end of this panel. Really, we have 5 cool transformers of the digital universe here in the panel. And I ask you, please introduce yourself and let's share with the audience what exactly you are doing in your company. Alex.
Yeah, so Alex Bechtel, I'm the global head of digital products at DWS, and part of that team is also our digital assets franchise. We do various things. We have issued a crypto ETC, a Bitcoin and an Ethereum ETC last year. We are one of the co-founders and co-investors into AllUnity, where I'm also currently the chairman of the board. That's a stablecoin, gonna be soon, hopefully, a Euro stablecoin issuer. And thirdly, we are of course also engaged in tokenization, which for us means tokenizing fund shares or investing into tokenized funds. We have built up a, let's say, team around digital assets roughly 2.5 years ago. And yeah, are pretty engaged, I would say, in that topic since then.
Simon, yeah, I'm currently working at Hauck Aufhäuser Lampe. I build a digital asset business unit there with roughly 20 people. We have gained 3 licenses by BaFin, custody, Manco, so crypto funds and crypto security registrar. Been in the same role before at Deutsche Börse Group, and as of next week, I will join AllUnity as CFO and CPO.
Sai,
congratulations.
go ahead.
Hi, good morning, everyone. My name is Sai. I represent Sygnum Bank. We are a digital asset bank, essentially with a similar license like any other Swiss bank, but one that allows us to essentially offer digital assets to all of our clients. And we focus on private institutional clients as well as banks. And that's specific to what my team does in particular. So we have about 20 plus banks on the platform who essentially provide digital assets in a fully regulated way to their end clients. So this is, I think, the most interesting piece to explore and discuss within the scope of this panel. Pleasure and looking forward to it.
Great. Manuel.
Yeah, Manuel.
I run business development outside of North America for Fidelity Digital Assets. Fidelity Digital Assets is the digital assets arm of Fidelity Investments, which is broadly known as a very large asset manager and financial services firm. My part of the business focuses on custody and brokerage, mostly for crypto assets, for things like Bitcoin and Ether. We're probably the longest standing sort of large financial institution in this space. So been doing this for some time, since 2019.
Hi, my name is Anya. As you can see, the organizers decided they need a woman on a panel, but forgot the microphone. But that's all right. So I'm with Galaxy Digital. We basically, I mean, most people probably heard about it. We have an asset management side of the business with active passive funds, VC fund. We have a trading desk as well, so one of the largest OTC trading desks globally. And on the infrastructure side of the business, we have a Bitcoin miner out of Texas. We have a very large staking business that has grown quite quickly to about 5 billion assets staked. And then we have the custody business. So we're end-to-end self-custody solution for like banks, custodians, and exchanges. So I'm looking forward to the panel.
Okay, thank you very much. So as you can see, it's a very heterogeneous panel from not just here. Glad to have you here on the panel as well, but also you're from the geographies, but also you're from the business entities or the business objectives here you have. So I'm very curious here to find also out what are the different developments in the various markets and also in the various geographies. Anya, I would like to start with you. Your view here on the state of crypto adoption in general. Where are we now, and what are you think are the next steps here in developing of these markets?
Well, it's interesting, right? Because just last night at a speaker's dinner, we were talking like there is that many service providers all chasing certain pools of money, and we all going after the same people who actually hold in crypto, right? So I think for us at this point, it'd be really good to see that pool grow quite a bit. And we just had a chat with you actually about the fact that not a lot of asset managers have entered the space yet. But I mean, we see our business as a Galaxy grow year on year. We've been in it for the last 7 years. So, I mean, overall, I think it's looking very positive.
Manuel, what's the view on Fidelity on that?
Yeah, so I think that's. Hello. Oh, there we go. I think there's kind of two sides of it, right? So there's a demand side, which Anya alluded to, and I agree with you. There's a, you know, you need kind of net new entrants, obviously in most markets, but particularly in kind of emerging markets, not from a geographical perspective, from an asset class perspective, and the other side of that is the infrastructure that allows that access. And so we were quite, from an early on perspective, not necessarily on the asset management side, but certainly on the infrastructure side, we saw that, and we'll come to education in a second, but infrastructure in terms of custody, in terms of market access. And we know how, and Europe, by the way, led the way on the exchange traded product side in terms of giving that access. There's still more to be done, all the way from retail to institutional investors, right? From a retail perspective, if you think about the demographics that invest into crypto, they have tended to be younger and sort of more adventurous, but there's probably still demographics, and we've seen some of that play out in the US with the launch of the ETFs, right? There's certain demographics that are interested in this space, but they will only access it if it ticks a number of boxes, whether that's the investment vehicle, whether that's the institution that's distributing that vehicle or giving access. And so we think that there's still a large pool of wealth at the individual level that's still to be accessed. And then at the institutional level, to Anya's point, there's a huge pool of assets that is still to be accessed. You know, we've seen some growth in sort of the corporate treasury space, and the asset management space is kind of catching up. But we know that these institutional allocators have very, very large pools of money, and the truth is they have not participated in a lot of the returns that this asset class has delivered for investors. So I think there's some pressure now, particularly as the US is kind of getting on board from a regulatory perspective. I think there's a bit of pressure there.
We'll come back to that in a moment. Sai, from your point of view here, you are a regular bank, but a particular regular bank. So who is driving innovation? Are these in Swiss? Are these the banks or are the other players?
Look, I think it's a blend of everything. The truth is, if you try to understand what's really going on in the markets, is you can wax poetic about all the frontier applications, about really the complicated and innovative things that startups do. And that's fantastic work. It advances us from a financial technology perspective very far. But the big question is, where is the largest impact for the largest group of future crypto users? All those retail users who currently are maybe using exchanges or similar products, which isn't a bad thing, right? So where is the next wave or inflection point within institutional adoption? And the feeling that we are getting more and more now is that it's within the regulated and institutionalized space, and specifically within banking. Because of a lot of the changes that we've seen happening in the past few years with non-regulated players, customers start to understand the value of custody, for example, and its different applications, and they come to regulated players. So I feel that more likely within the next span of 1 to 2 years, most or majority of the banks will be offering crypto-based services in one way or another out of a regulated offering fully. And most of these will be legal and applicable within most jurisdictions. And I'm not only talking about the specific places like Switzerland when you're allowed to do this, or Singapore or the like. I'm really talking about the large players, for example, in America, where there's a huge political shift and change, and large banks that have trillions and trillions of assets that are about to overnight have customers who bought Tesla stock, and lo and behold, they will be able to buy Bitcoin, Ethereum, and so on and so forth. And sorry to kind of draw it out, but the most important aspect of this is that the innovative technologies that underpin this are actually very basic. I mean, the core banking system is a ledger that can reflect what is happening on the blockchain. As simple as that. These are commoditized products that are available today, irrespective of the fact that innovation should happen outside of that.
Maybe Simon and Alex, you share this view, and how is your German perspective here on this, what Sai said with regard to Swiss?
I think I would share the perspective because from Hauck perspective, we are closely working together. So actually, we do the crypto funds together, and I'm very happy that we can do that. So I think shaping it is possible from either way. It's very much driven by whom you have on your side. Yeah? But what I would maybe add is, here we are talking about infrastructure. And I would ask the question, what is really infrastructure? I see a lot of projects within banks and financial institutions overall that build stuff and rails, but is it really infrastructure? If we see that we have assets that are digital now on public chains, and you build stuff on top of that, that cuts it off, is this really infrastructure? Or is this something different? So I think many projects start running from components and business cases and use cases and start from there and don't really understand what you need up front in the beginning so that you are open to other use cases. We were yesterday.
Could you give a precise example?
Yeah, I'm about to do. So we were yesterday at the roundtable at Moody's, and this was exactly the discussion, because I see now projects, for example, running by the ECB, where they build a digital euro and they cut out public chains. It's stupid. It's very stupid. Because you come from a use case perspective without respecting the infrastructure component, and you are not open to what is about to come. So what is for me a piece of infrastructure? Wallet. If I want to hold any token, I need a wallet. Yeah? If I build a project that doesn't respect that, or is not open also to other wallets or stuff like that, I disrespect the underlying infrastructure of the assets we are talking about. And so I see so-called infrastructure projects, I would call the digital euro, for example, also an infrastructure project, that are ideologically driven and by people that do not respect infrastructure truly. Because if they would be open to true infrastructure, they would start with building the rails and putting the trains on top. Yeah? And if we don't have in banks and institutions, and all of you running projects maybe, or most of you running projects within institutions, and you're running a project, and within your project you don't have a wallet that is open to tokens that come from outside, is this really infrastructure for the future? And we are building it for the future. Don't assume that the use cases and the applications will look just like what we do right now within the banks. It will not be the bonds as of today, it will not be the payments as of today, it will be different in the future. And the question is, have you prepared your organization well with the right piece of infrastructure so that it is really open to whatever might come in the future?
So this was a question to you. Who is prepared?
So there's one rule: you should never ask question to an audience that makes them have to raise their hand. You always have to do the different. Who is not prepared? You have to ask, or who is prepared? You have to ask. So you ask who's not prepared, because then they don't have to raise their hand. I think it makes sense that Simon and I share a mic, because we have very similar views on things. And I also, I have the title of our session here in front of me, from legacy to ledger. I also wanted to add kind of a comment on what does that actually mean from legacy to ledger, and where do we stand there? So, current financial market infrastructure, and I'm immensely simplifying that now, is usually about we want to exchange an asset for money, or we want to exchange money for money, or I want to send money, right? These are the rails we are using today. And the way this works usually, like Frank, if you now go to, and I hope you're a client of Deutsche Bank, you go to your Deutsche Bank account, you have to identify yourself, and then you can basically initiate a transaction. So what Deutsche Bank does, it says, okay, I have here an account from Frank, and I'm changing that number in that account, and then I'm basically sending a text message to the receiving bank, telling that receiving bank, dear receiving bank, I have reduced the amount of money in Frank's account. Please increase the amount of money of the receiving end. And they're basically communicating to each other, right? And this is how our financial system works today. We have individually managed databases by individual institutions. And the reason why it all works is because these institutions are talking to each other all the time. They're communicating, right? And this is what we usually call reconciliation of independently managed databases. Now the vision, and this is then the ledger part of blockchain technology, is that instead of having these thousands of different databases, which are hard to manage when it goes cross borders, you can't do it on a Sunday afternoon, all these kinds of things, let's replace it actually by one database that we all share and we all manage together, which is called a blockchain, right? And everyone has access to that blockchain. And again, simplified, everyone can actually write transactions directly into that blockchain. And then we have a super smart consensus algorithm that makes sure that everything works. Which is, of course, I guess everyone agrees that sounds super efficient and let's do that, right? And that's the vision. But then we have reality, and some of the colleagues here have mentioned that already. There is, of course, not the one blockchain that everyone uses today. We have hundreds of blockchains. We have public blockchains, we have private blockchains, we have blockchains that are not interoperable. We have securities laws that say, look, you can't just put a security on a permissionless blockchain and send it around. You have to do things like KYC and all these kinds of things. And like my main, let's say, journey I'm on at the moment, and I also try to learn, is how do we bring that vision to reality, right? Because that vision in a dream world would work perfectly fine, but then there's reality, and we have to make these two things kind of work and fit together. And this is what I guess we are all working on.
But how far is the gap right now between vision and reality? And maybe you can also distinct a little bit between the sectors you are working in. Maybe Alex, you want to start?
Maybe what are the main obstacles?
That's my co-moderator, Nick. Thank you for being here.
So I'm happy to start, and I'll be quick. I'll just something I observe. So I would say the gap is totally depends on the use case. I'm generalizing a lot at the moment. The gap is pretty big for anything that's not purely crypto related. So as soon as we talk about tokenization of real world assets, maybe except for stable coins, but I see two tendencies at the moment. I see on the one hand, we have these pure crypto DeFi players that started completely public permissionless, which are now moving more and more towards, let's try to make what we have built here feasible and accessible for the regulated world. And then we talk about institutional DeFi, we have like verified pool from Coinbase have been announced, these kinds of things. So that's like one tendency I see. And then there's another tendency which starts in the traditional world. These are the banks and the asset managers, which also start building infrastructure, usually not on a public permissionless blockchain, but they are now trying to open up a bit. And just let me mention one, like Swiat, for instance, right? Swiat, completely closed ecosystem, now slowly trying to open up. And I see like these two streams moving maybe together, or at least into the same direction. The very open one getting a little bit more close to make it work, and the completely closed one making it a little bit more open to actually have a proper use case and a value add to the existing ecosystem.
Can I just add that I
please.
think one of the huge obstacles we still have is, the bad news that are in the industry. Like the Bybit hack helped my business a lot, but I don't think it helped the industry as a whole. And I mean, Bybit hack, I think probably most people here heard it was like $1.5 billion stolen from an exchange. And it's a crypto exchange. They've been in business for a while. That's people who know how that stuff works and how it operates. And they still, like, to your point about wallets and infrastructure, there is still a lack of deep technical expertise and operational systems around that. So for example, I think people go like wallets. Okay, I'll just give a very quick rundown of, like, there are hot wallets, one private key, always online. That's like your MetaMask example, right? Then the evolution up from that is multi-sig, which is native to Bitcoin, but can be created for Ethereum. That's basically, we're like, oh, okay, having one private key that's always online, that's bad. Let's have at least like 3. So 3 people have to come together, sign a transaction. Then we have MPC, which is very similar to multisig, but it's the one part anyway. And then you have cold infrastructure, right? Which, and sometimes I think when I talk to people, they always think about, okay, the most important thing I have to do is to safeguard the private key, because everybody knows, like, if someone steals your private key, they can steal your funds. But what a lot of people don't really think about is that the private key is dumb. So it will sign on whatever transaction you put in front of it. So you really need to make sure that as you're preparing the transaction, there is no malicious inputs, right? So I'm sending like 1 Ethereum to Manuel here. I sign on that. After it's signed, a transaction cannot be tampered with. So that's why it can be made public. Before it's signed, it needs to be done in a highly secure way. And that's why we have things like cold storage or impenetrable storage. And then again, terms like cold storage have been misused in the past as well, where like a nano ledger device might be cold because it's sitting in your safe at home. That's fine, but as soon as you plug it into something, it has to request data from the blockchain system, so it becomes warm in effect. So I just think it's fascinating that we see hacks like that still occur from companies that have highly secure setup. And I think one of the reasons we still have a gap and we don't see more entrants coming into the space is that we need to have at least like a year or two without $1 billion hack. And that will make everybody feel a lot more comfortable. So we need to help people educate themselves on the proper custody setup.
Just before you continue, if there are any questions, really, please feel free to raise your hand. I think we want to have an interactive discussion. It is interactive, but you can also engage. Manuel, go ahead.
I was going to say, so I agree in this. So I completely agree with things like custody are not commoditized, and I think there is some perception, particularly actually from sort of more traditional players that come into this space and then get sold sort of a dream of crypto infrastructure fully developed. And a lot of the time, you're right, like there's institutions that should know what they're doing and actually they have subpar infrastructure. So I think things like custody is not commoditized. And there's very different ranges of what you can do. So 100% there. On the flip side, however, from an investment standpoint, the things like the Bybit hack, things like 3 Arrows Capital, like, and so on and so forth, are actually what makes crypto uncorrelated to any other tech stock. And so from an investment standpoint, it's actually a really important thing that the community based out, and the fact that you have these weird things about crypto is what makes it a more investable asset.
I like this aspect. It's funny.
Yeah, one question just here to complete.
It's not a judgment, just a fact, right?
No.
Yeah.
But the importance of custody here for the further development and the mass adoption. So could you rank, so how important is the topic of custody, safe or secure custody for the further adoption?
Well, I don't even see digital assets being separate from custody. That is literally what a digital asset is something that has a private key that's stored somewhere. So it's really just two sides of the same technology.
I'm biased because I work for a custodian, so number one. But we do get data on this. So we have customer surveys, right? And custody and cybersecurity is inevitably like a top 5 concern.
What would be number one? Is there a clear number one or a clear number 1 and 2?
Yeah, so it tends to, again, depends on investor segment. Things like volatility and regulation are normally in there as well.
Regulation is a good point. We'll come a bit later to that. But Simon, you were about.
Yeah, maybe just quickly. So I would agree, like 2 years without having a crash and a large exchange hack would be nice. Never experienced it though in the last 8-9 years. So let's see. But I think if you look at large corporates failing with huge amounts, traditional finance is much better at that than crypto. Yeah, they had failed like with much higher volumes, so you don't need crypto for that. Yeah, I mean we had our financial crisis every now and then, so it's part of finance, I think, to be fair. For the crypto part, it's more hacks maybe, then instead of like creating structured products that are very complicated and fail, whatever, ultimately there is a process of correction in the whole value chain that's simply part of it. The question with regard to the obstacles that you raised, or Nick as well, is something I think that it's partially much simpler. Yeah, as you elaborated, I think people in the room are familiar with it. But if somebody from a bank that has not involved in the topic yet comes with it, it looks very complicated. So crypto and digital asset at first looks very complicated. So that's not easy to approach at first. Yeah, so people don't understand it, and they are afraid maybe to touch it to some extent still, even now after years of education in large institutions. And then it seems dangerous because of the hacks, indeed. Yeah, so it's complicated, it's dangerous, and nobody can really get a grab on it. So best thing is, I think, to try it out. Yeah, and that is what I can recommend really to everybody, that you show the people in the organizations to avoid obstacles in terms of adoption, how it works. Show them a tool. Let them see an on-chain transaction, on a testnet, and show them that it really works. When we did a first huge security with Siemens, we gave them a demo, and they opened Block Explorer on their own PCs, and then they saw that the security moved. That helped a lot. So this is what I would recommend to overcome obstacles.
So I really like the question. I would be also interested what the other panelists say about it. And I think when it comes to adoption or obstacles, you always have to distinguish crypto and then anything around tokenization of real world assets. Because for me, the main, and now I'm talking now from the point of view of having worked at a Deutsche Bank for a couple of years on this topic and now at DWS. I mean, at Deutsche Bank, we basically, when we built up that crypto team, it was during the 2020-2021 bull run. It was unbelievable how many clients approached us and said, when is Deutsche finally starting to offer trading cryptocurrencies? So it was clear that if we do that, there would be a use case for us, right? There was not a single person that approached us or me during those three years or so I was there and asked, hey, could you please tokenize a piece of real estate for me? Because I'm super interested in investing into tokenized real estate. So usually when we start evaluating new projects, we look at, is it technically feasible? Check, that's done, right? We have great service providers who can help us do that. Is it from a regulatory point of view feasible? I would also say check. Now in Europe, we have MiCA. It's actually clear what you have to do if you want to do this stuff. But then you have the commercial viability, right? Do you have a use case? Do you have a business case? Sorry, can you earn money with it? And then with crypto, I would say it's not too hard to find a proper use case or business case, depending on which business you're operating in. When it comes to tokenizing assets, it's a whole different story. Because if I want to play in the crypto space or if I want to issue a stablecoin, for instance, it really pays off to be first. Being the first Bitcoin ETF, great. Being the first stablecoin issuer, great. Being the first person who has tokenized a piece of real estate, I'm alone. I don't have a buyer. I don't have someone who kind of provides services around that stuff. There is no first mover advantage around tokenization of real world assets. And I believe that's the main reason why we have this cold start problem and why it takes so long for this to kind of materialize and happen. So, and that's for me kind of one of the main obstacles I see, that you have this cold start problem and no incentive to be first.
Maybe just to add and kind of touch on a lot of the elements that you discussed, right? Infrastructure, use cases, custody in particular, and so on. I think the difference and sometimes the reason why the gap is so big as it seems for now, why the transcendence between the traditional and non-traditional, the crypto world, is so big, is because it's intended to be so. And I mean this from the very following reason, right? When we were approaching banks maybe 3-4 years ago, we would be laughed out of boardrooms. When we came to them and said, let's do the crypto thing in your bank, they would say, why? What are you talking about? Today, there are the same banks coming to us and saying, guys, how do we do this thing? And this philosophical shift and change is probably one of the most important and intended elements. Because ultimately, and this is a side joke we always do when we're talking to senior stakeholders, what do you guys do? We are dealing in paradoxes. Well, what's the paradox? The paradox is that we are a bank, a centralized entity, selling you infrastructure to enable decentralized technology within your centralized entity, which, by the way, was set up and is living and existing, and your customers trust you because it is centralized. And I think this is the most interesting and exciting paradox, which to me really, the exploration of it really comes from the use case. Because most of these entities, when they try to find or resolve these gaps, they try to find analogous ways to be able to adopt this technology via the core banking system, which is also a ledger in one way or another, via traditional and common use cases such as markets and exchanges, via payments and so on and so forth. So I think this is the most important, the philosophical difference. Because, for example, we don't look at crypto-based company and say, why aren't you so financial, like traditional finance adopted, right? If you know what I mean. It doesn't have to work in the reverse way either. And this is probably the reason why there is such a gap.